What are the economic dangers of central bank digital currencies? Over the past few years, the idea of central bank digital currencies has gained considerable traction within the financial world as both emerging and advanced economies explore plans to launch digital currencies. At its core, CBDCs are digital representations of a country's fiat currency issued and controlled directly by a nation's central bank. Though the potential advantages of CBDCs such as faster and more efficient transaction processing, financial inclusion, reduced dependence on physical cash, and enhanced monetary controls are often touted by its proponents, there are grave implications that need to be examined before implementation. This analysis aims to present the dangers that CBDCs pose to global economic stability and analyze their potential impacts on financial institutions, market structures, privacy rights, and geopolitical power dynamics. Erosion of the traditional banking sector. The implementation of CBDCs could lead to significant disruption of the existing banking sector. Currently, commercial banks play a critical intermediary role within the economy by lending money deposited by customers to borrowers, thereby ensuring the smooth flow of credit and economic growth. However, CBDCs could facilitate a mass exodus of depositors from traditional banks to central banks, as consumers may perceive central banks as more secure due to their digital architecture and state-backed guarantees. This scenario could leave commercial banks with a diminished deposit base, thereby curtailing their ability to extend credit and loans vital for economic growth. While central banks could take on the role of lending, the immense concentration of power in a single institution may have adverse effects on financial competition and consumer choice. Moreover, an increased reliance on the central bank may bring about heightened systemic risk. This is due to decreased diversification, a paradox as the initial goal of CBDC implementation was to create a safer and more secure financial system. The risk of bank runs and financial instability due to CBDCs have the potential to exacerbate financial instability during periods of economic decline or uncertainty, due to the ease with which consumers can move their funds from commercial to central bank accounts. The velocity at which funds can be transferred creates a greater potential for bank runs, as investors resort to panic withdrawals, further destabilizing the financial sector. During economic crises, one of the critical responsibilities of central banks involves the implementation of monetary policies that provide liquidity to financial institutions to stay solvent. However, with the widespread adoption of CBDCs, central banks would be subject to the market pressures of deposit demand, potentially limiting their ability to exercise liquidity management and tightening the overall economy. Some of the privacy concerns and potential personal surveillances are due to the implementation of the inherent traceability and visibility of digital transactions. While this feature can be heralded as an effective means for combating criminal activities such as money laundering and terrorism financing, the same technological advancements expose citizens and businesses to increased monitoring by governmental authorities. So let that sink in for a second. If they can track all criminal transactions, then you, the individual, have no hope of privacy. As governments transition from physical cash to CBDCs, citizens lose the anonymity that cash transactions provide. In the absence of appropriate safeguards and regulatory structures, the potential for misuse by authoritarians in the form of mass surveillance or targeted attacks on political dissidents and specific sectors of the population becomes more prominent. Furthermore, misguided financial surveillance policies could implicate innocent citizens or deter innovation in emerging industries for fear of regulatory backlash. And you may ask, what are the geopolitical power dynamics and financial exclusion aspects of a CBDC? Well, that's not so simple to explain. The impact of CBDCs extends beyond economics and has the potential to reshape geopolitical powers globally. The conventional capabilities of financial sanctions as an essential foreign policy tool may be eroded if nations can bypass traditional banking systems using CBDCs backed by alternative currencies. Consequently, such developments may accelerate the decline of the US dollar as the world's reserve currency, which undermines American economic power. Additionally, unintended consequences may arise from competition between nations in the digital currency sphere. A potential digital currency war may emerge, with countries attempting to undermine other nations' CBDCs or manipulate exchange rates in a bid to establish their digital currencies as dominant in global trade. These tensions run the risk of exacerbating existing geopolitical conflicts or obstacles to international trade and financial cooperation. Moreover, while initially viewed as a tool for financial inclusion, CBDCs may inadvertently contribute to the exclusion of unbanked or underbanked populations in regions with limited access to the internet or digital devices. This scenario exacerbates existing inequalities and hinders individuals' and businesses' abilities to partake in the global economy. So in conclusion, the rapid advances in the development of central bank digital currencies present a unique set of opportunities and risks for the global economy. Although there are potential benefits in transaction efficiency, traceability, and reduced reliance on physical cash, the stark risks posed by CBDCs merit cautious and thoughtful consideration. The threats to financial stability, individual privacy, geopolitical stability, and emerging concerns of exclusion demand further research and a thorough understanding of CBDC implementation's long-term implications. Policymakers and regulators worldwide must weigh the pros and cons of CBDC adoption and formulate strategies that account for the complexity between technology, economics, and global power dynamics. Thanks for watching. Stay tuned for future videos.